So right now, somewhere in the Midwest, there is a 160-year-old bank that is basically using an artificial intelligence layer to actively spy on, well, not spy, but monitor the internal Slack and Microsoft Teams messages of its own software engineers.
Yeah, which sounds entirely like a sci-fi movie.
Right, it's wild. It's reading the sentiment of their daily developer chatter, looking for early indicators of panic or confusion, and then it directly updates a master Microsoft project plan to prevent this, multi-billion-dollar technical failure.
And they are doing all of this while trying to digest one of the largest regional bank mergers of the entire decade.
Exactly. So today we are looking right under the hood of the Q2 2026 earnings call for Third Bancorp. Ticker symbol is FITB. And for those of you listening, we're doing this talk ticker style.
So that means we are data forward, we translate all that corporate spin into actual financial mechanics, and we deliver an opinionated verdict on what these numbers actually mean for you, the retail investor.
We are pulling straight from the official transcript today, featuring CEO Tim Spence and CFO Brian Preston. And this is a big one.
It really is. I mean, the context around this specific quarter, it just can't be overstated. Fifth Third is in a highly unique transformational phase. They recently acquired Comerica, and they're attempting to execute this massive integration while navigating a really transitional macroeconomic environment. Shifting yield curves, commercial real estate anxiety, and just intense deposit competition.
Yeah, the market has basically been waiting to see if this merger was a strategic masterstroke or if they just absorbed a balance sheet that's going to drag down their legacy performance for years.
Which is exactly where we need to start.
Right, because, earnings calls are inherently designed to sanitize reality. You have executives on these calls highlighting adjusted metrics, smoothing over friction points, and framing literally every minor headwind as a, quote, strategic transition.
Oh, absolutely. It's an art form for them.
It is. So as we dig into these sources for you guys, how do we cut through that management narrative? How do we know we aren't just looking at the illusion of growth created by bolting two balance sheets together while the core operating engine is actually falling apart underneath?
Well, you isolate the variables that management simply cannot spin. You strip away the absolute revenue numbers, which obviously those inflate when you buy a whole other bank, and you ruthlessly examine the margins.
Right.
You look at the capital efficiency ratios, and you look at the retention data. If a merger is fundamentally flawed, it bleeds immediately into the expense line and the customer attrition rates.
You can't hide fleeing depositors for very long.
Exactly. You can't hide a degrading loan portfolio behind a glossy slide deck. So, we just follow the math.
Then let's jump straight into that math. Let's start with the headline profitability. So the raw GAAP earnings per share reported was 83 cents. But the market immediately anchored to the adjusted diluted EPS, which came in at $1.02. Now, typically, relying on adjusted EPS is where you find the bodies buried.
Yeah, it's usually a red flag.
Because management teams love to exclude these quote-unquote one-time costs that somehow mysteriously happen every single quarter.
It's a necessary skepticism for sure.
Except.
But in this specific quarter, understanding the gap between that 83 cents and the $1.02 is crucial for you to model the bank's true run rate.
So what exactly is that 19-cent differential?
It stems entirely from after-tax merger charges. When you absorb an institution the size of Comerica, the fictional costs are just front-loaded, and they are aggressive.
So we're talking about what, massive severance packages?
Exactly. Severance packages for redundant C-suite executives, penalties for breaking commercial real estate leases on overlapping branch footprints, and, 8-figure consulting fees for sunsetting all that legacy software architecture.
But the argument there, though, is that integrations often drag on for years. So at what point do these one-time merger charges just become a permanent structural drag on the operating leverage?
And that is the risk with serial acquirers. But Fifth Third is signaling a very tight timeline here. They are pulling forward these expenses precisely to clean up the income statement by Q4.
Oh, interesting.
Yeah. So if you want to value the core banking operations, like how much organic cash the lending and fee engines are actually throwing off without the noise of severances and lease breakages, that $1.02 figure is the accurate baseline.
Okay, so it indicates that the underlying mechanism is highly profitable, even in the middle of all this operational chaos.
Exactly.
And that profitability is being driven by a massive surge in the core revenue engine. So net interest income, or NII, came in at $2.22 billion. That is a 14% sequential jump.
Which is huge.
It is. But the number that really matters here, the one that dictates the pricing power of the bank, is the net interest margin. NI expanded 6 basis points sequentially to hit 3.36%.
Right, 3.36% on a fully taxable equivalent basis. And the expansion itself is the critical data point here.
Because, just to translate this for you listening, if a bank is basically a retail store, NIM is the markup on the goods, right? It's the difference between what the bank pays you for your deposits and what they charge a business for a loan.
That's a perfect way to put it. And in an environment where the cost of those deposits has been fiercely elevated, just maintaining your NIM is a victory.
Right.
Expanding it by 6 basis points across a balance sheet of this magnitude, I mean, that equates to immense compounding revenue. CFO Brian Preston was actually very transparent about the mechanics driving this too.
Yeah, he broke it down perfectly.
He did. Exactly half of that expansion, so 3 basis points, is purely structural. It's just the result of having a full quarter of the Comerica balance sheet fully weighted in the average.
Because Q1 only captured a partial quarter of the merger.
Exactly. So it's just arithmetic.
Right, so that 3 basis points is essentially the bought margin. But the remaining 3 basis points of organic expansion is what really caught my attention. Specifically, the fixed rate asset repricing dynamic.
Oh, yeah. That is the tailwind every single regional bank has been praying for.
I mean, during the zero interest rate environment, banks were just accumulating these massive portfolios of low yielding securities and fixed rate loans.
They were basically trapped in duration risk.
Exactly. But as we sit here in 2026, those legacy assets are finally maturing. So Fifth Third is taking the cash from a maturing loan that was maybe yielding like 3%, and they are immediately deploying it back into the current market at 7 or 8%.
Yeah. It is an automatic structural escalator for their margin. It requires 0 new customer acquisition. It literally just requires patience.
It's amazing. And as long as the terminal rate remains relatively elevated, that repricing tailwind continues to pad the NII.
Yeah.
But generating gross revenue is only half the equation, right?
Yeah.
The real test of a management team is capital efficiency.
Absolutely.
So let's look at adjusted ROTCE, which is return on average tangible common equity. It hit 19.0%, up sharply from 16.0% in the first quarter.
And a 19% ROTCE is just an elite print for a regional bank. It demonstrates an incredibly tight command over how they're actually deploying their hard, tangible capital.
Because when you strip out the goodwill and the intangibles generated by that Comerica premium, you are left with the bank's actual physical equity.
Right. And generating a 19% return on that equity up 300 basis points sequentially, that just proves that the scale benefits of this merger are already dropping straight to the bottom line.
And that operational leverage is totally mirrored in the adjusted efficiency ratio, which plummeted from 61.9% in Q1 down to 57.1% this quarter. Moving an efficiency ratio almost 480 basis points in a 3-month window is just aggressive.
It is. And they actually reaffirmed their run rate target of driving that down even further to 53%. Yeah, which implies there is still a massive amount of redundant operating expense left to cut from the combined entity. But, you know, the metric that ultimately validates this entire strategic maneuver is tangible book value per share.
Yes, TBV. It increased to $23.15. That is up 10% year over year. And most importantly, it's up 7% since the Comerica announcement.
And that 7% accretion is the linchpin of this whole story.
Right, because when Tim Spence announced this deal, he promised 0 tangible book value dilution, which is crazy because historically, major bank acquisitions destroy TBV right out of the gate.
Oh, always. Because the acquirer usually has to issue a flood of new shares or pay this exorbitant premium, which deeply dilutes the existing shareholders in the near term. And the promise is always, you know, Synergies will earn that value back over 5 years.
It's the classic trust us management pivot.
Exactly. But Fifth Third structured and priced this Comerica deal so effectively that they bypassed the dilution trough entirely.
Growing TBV by 7% post-announcement proves the deal was intrinsically accretive from day one. They didn't mortgage the legacy shareholders just to buy growth.
No, they didn't.
Okay, so the math undeniably points to a highly accretive quarter.
Yeah.
But I want to pivot to the actual execution. Because, let's be honest, the legal closing of a merger is just paperwork.
Oh, the real nightmare is the tech.
Yes. The true existential threat to this 19% ROTCE is the technical systems conversion.
Yeah.
They are migrating Comerica's entire architecture onto Fifth Third systems over Labor Day weekend.
Which is the single highest risk event in a bank's operational life cycle.
Yeah.
I mean, you are dealing with a cardiovascular graft of corporate liquidity.
It's like changing the engines on a commercial jet whilst at cruising altitude.
That is exactly what it is. You are routing daily payroll, sweep accounts, complex treasury management protocols, all from legacy mainframe architecture into a completely new environment. If that API logic fails, or if, the database schemas mismatch for even 10 minutes on a Tuesday morning, a middle market manufacturing firm misses payroll, and the reputational damage is irreversible.
Which brings us back to that AI intelligence layer monitoring the Microsoft project plan that I mentioned in the intro.
Right.
Because when I first read that in the transcript, I thought, okay, this is just a buzzword gimmick. But looking at the mechanics of it, it is actually a brilliant risk mitigation strategy.
It really is. Tim Spence detailed exactly how it functions on the call. In a traditional migration of this scale, the central command team relies on manual status updates.
Right.
A project manager basically asks the database engineers, hey, are we on track? And the engineers say yes, right up until the exact moment a catastrophic failure occurs.
Because no one wants to be the guy holding up the launch.
Exactly. The AI layer bypasses that human reporting bias. By integrating with their internal communications, like Slack and Teams, it performs real-time sentiment analysis on the developer channels.
Wait, so it's literally reading the room, essentially.
Essentially, yes. If it detects a sudden spike in urgency or, specific error code chatter or prolonged bottlenecks in a specific integration node, it instantly flags the master project plan and alerts senior leadership.
So it's identifying the friction before the friction becomes a critical path delay. That is incredible.
Yeah.
And honestly, this technological command is why they are so confident in pulling forward that $850 million in annualized run rate expense synergies.
Yep. Once the Comerica legacy systems are permanently sunset post-Labor Day, they stop paying for dual software licenses, redundant AWS instances, parallel operational teams, all of it.
And that $850 million goes straight to compressing that efficiency ratio toward their 53% target.
Right. But, cutting costs is actually the easiest part of a merger.
That's true.
The true test is defending the perimeter. Whenever a bank announces an acquisition, literally every competitor in the region activates their commercial banking teams to try and poach frustrated clients.
Yeah, the pitch is always, your bank is distracted, their systems are changing, come over to us.
Exactly. So the fact that Fifth Third reported a 99.4% retention rate for Comerica's commercial customers since the beginning of the year, that is statistically absurd.
It really is. I mean, 99.4% retention implies they're actually beating normalized baseline attrition rates.
Yeah.
Usually a commercial book naturally churns at a higher rate simply due to, business closures, acquisitions, or organic turnover. To hold 99.4% of a commercial book during a massive integration means competitors are just failing completely to penetrate their defense.
And the consumer retention metric is even more aggressive. It's over 102%.
Which obviously requires factoring in gross new customer acquisition to offset the natural churn. They didn't just defend the Comerica footprint, they utilized the new branch network to aggressively take market share.
Which segues perfectly into their funding strategy, because all this talk of loan growth and margin expansion is completely moot if you can't fund the balance sheet in a high-rate environment.
Right, the hunt for deposits is the core battlefield right now. And Fifth Third reported average core deposits of $229 billion. That's an 11% sequential increase.
But CFO Brian Preston was highly pragmatic on the call about this. He didn't sugarcoat the macro reality at all. He explicitly noted that it's getting structurally more expensive to grow deposits in their legacy Midwest markets.
Yeah, because the consumer deposit franchise there is fiercely competitive, and paying up for yield-chasing deposits just crushes your NIM.
So the strategy isn't to fight a rate war in Ohio. The strategy is to leverage the new Comerica footprint where they actually have a distinct structural advantage.
Okay, right. Because Comerica gave them access to the Southwest. We're talking Texas, Arizona, California. But the wild part is Comerica had basically allowed that retail footprint to completely stagnate.
Oh, totally.
Yeah.
Tim Spence noted that Comerica hadn't seen net new household growth in those markets in years. Because Comerica was a phenomenal commercial middle market bank, but they completely neglected the retail deposit gathering engine.
Right.
So Fifth Third stepped in, applied their direct marketing architecture, optimized the product suite, and in a single quarter, they drove a 4% unannualized growth in checking households in the Southwest.
4% unannualized. If you are an investor and they sustain that momentum, you are looking at a 16% annualized growth rate in a highly saturated, hyper-competitive geography like Texas and California.
It's massive.
That direct marketing engine pulled in $2.5 billion in new deposits in the Southwest alone. That more than doubled their internal expectation of $1 billion.
And we really have to look at the composition of those deposits because that dictates the profitability. They aren't just bringing in expensive, rate-sensitive CD money. They are targeting operating accounts.
Yes, DDA accounts.
Right. Fifth Third reported that average non-interest-bearing balances held steady at 28% of core deposits.
And for you listening, DDA stands for demand deposit accounts, basically standard checking accounts where funds can be withdrawn at any time. And that 28% figure, that is their margin mode. In an environment where the Fed funds rate makes wholesale borrowing incredibly expensive, having 28% of your deposit base costing you absolutely zero is a structural superpower.
Yep.
It allows them to absorb the higher cost of interest-bearing deposits while still expanding that overall NIM to 3.36%.
It also highlights a really crucial strategic decision they made on the commercial side, because Brian Preston noted that while they were rapidly acquiring consumer deposits, they intentionally allowed higher cost, non-relationship commercial balances to run off.
This is such a vital point. They actively chose to shrink certain commercial deposit lines. Now, why on earth would a bank turn away corporate cash?
Because it's institutional hot money. These are sophisticated corporate treasurers who will sweep millions of dollars to a competitor for an extra 2 basis points of yield.
Right. They have zero loyalty.
Zero. It is highly volatile, extremely expensive funding. And Fifth Third is drawing a hard line. If a corporate client isn't using them for treasury management, payment processing, or operational payroll if there is no sticky foundational relationship, Fifth Third refuses to overpay for their excess cash.
Wow.
They are systematically purging the hot money and replacing it with sticky, granular consumer operating accounts from the Southwest. It's a masterclass in liability management.
It really is. It's prioritizing the quality and the duration of the liability over just the sheer size of the balance sheet. Okay, so they have secured this massive, cheap funding base. How exactly are they deploying it?
Well, average portfolio loans hit $178 billion, up 13% sequentially.
But let's strip out the Comerica base effect and look at the core C&I growth, the commercial and industrial loans for working capital.
Right. C&I grew 2% sequentially. And this is really notable because the broader macro environment has actually seen significant C&I contraction lately.
Yeah, a lot of middle market companies are delaying CapEx and inventory builds because of interest rate uncertainty.
Exactly. Yet, Tim Spence pointed out that client confidence within their specific footprint remains really resilient. It's being driven by localized secular trends like manufacturing reshoring and infrastructure billouts.
But, the real alpha in their lending strategy right now isn't actually in traditional C&I. It's in their specialty verticals, specifically this digital platform called Provide.
Oh, Provide is fascinating.
It is. This is where Fifth Third is operating much more like a Silicon Valley fintech than a legacy regional bank. They acquired this platform a few years ago when it was just a niche player financing veterinary and dental practices.
Right.
And they've scaled it into a dominant small business lending engine.
The mechanics of the Provide platform are just brilliant because traditional SBA lending small business administration loans is notorious for extreme friction.
Endless paperwork.
Endless, opaque underwriting timelines, heavy physical branch reliance. Fifth Third basically utilized Provide to digitize and automate the UI UX, essentially offering a frictionless, API-driven onboarding experience for small business owners.
And the market share capture from that is undeniable. By leveraging this digital architecture, Fifth Third has catapulted from being the 31st largest SBA lender in the country a year ago to the 15th largest today.
Which is just a crazy jump.
You do not double your national ranking in a government-guaranteed lending program purely through better branch sales. You do it through superior technological infrastructure that reduces the time to funding for the borrower.
Exactly. But, as we know, a durable banking model cannot rely solely on the net interest margin and loan growth. The yield curve is entirely out of management's control.
So true.
What they can control is their alternative fee revenue, the non-interest income that provides a countercyclical ballast to the balance sheet.
And they are seeing aggressive compounding in their fee verticals. Let's look at Newline, which is their commercial payments platform. Revenue there surged 35% year over year.
A 35% growth rate is what you expect from a SaaS company, not a regional bank's payment division.
Right. Plus, it drove $5.3 billion in related sticky commercial deposits.
They also saw immense stability in their wealth and asset management division, which generated $256 million for the quarter. That brings total assets under management to $128 billion.
Wow.
Yeah, that division is officially operating at a $1 billion plus annualized fee run rate. It's highly profitable, very capital-light revenue.
But for me, the most compelling alternative revenue stream, structurally speaking, is the Direct Express program. This was basically a crown jewel embedded in the Comerica acquisition, and it is a massive driver of uncorrelated fee income.
It really is. Direct Express is the federal government's mechanism for distributing benefits like Social Security or Veterans Affairs payments to citizens who operate outside the traditional banking system.
So instead of cutting a physical check to an unbanked individual, the Treasury just routes the funds onto a prepaid debit card.
Exactly. Comerica held this contract, and Fifth Third is now migrating the entire infrastructure onto a modernized processing platform managed by Fiserv.
And the scale is just incredible. In just this quarter, they added 66,000 new beneficiaries to the platform. That generated $22 million in pure fee income, primarily through interchange mechanics every time the card is swiped, while simultaneously holding $3.7 billion in average deposits.
It is a completely captive, highly predictable revenue stream that is entirely divorced from commercial lending cycles or corporate CapEx trends.
It perfectly insulates the income statement. But, and there's always a but, whenever you see a bank aggressively expanding its loan book, rapidly scaling its digital lending platforms, and pushing into new geographies, the immediate question for any investor must be risk management.
Because growth in banking is easy, underwriting discipline is hard.
Exactly. So let's scrutinize the credit quality. The net charge-off ratio came in at 0.30%. That is the lowest level since the second quarter of 2023. They are operating at the absolute floor of their historical risk parameters.
Furthermore, they are maintaining an allowance for credit losses, the ACL, at 1.76% of total portfolio loans. When your actual realized losses are sitting at 30 basis points, and you're holding 176 basis points in reserve, that indicates an incredibly conservative provisioning model.
They are heavily over-reserved relative to their current loss profile, which gives them massive flexibility if the macro environment suddenly deteriorates.
Yes, they have a lot of padding.
But I do have a major pushback here regarding their macro risk profile. Because right now, the entire global financial system is hyperfixated on one singular trend: artificial intelligence infrastructure.
Oh, absolutely.
We are seeing unprecedented capital expenditure into data centers, GPUs, power generation, and in previous technological supercycles like the dot-com build-out of fiber optic networks, regional banks got absolutely decimated by over-leveraging into speculative infrastructure that eventually just went dark.
Yep.
So is Fifth Third chasing the AI yield by financing these massive data center projects?
It's a great question, and that specific risk was actually challenged by an analyst during the Q&A. And CEO Tim Spence's response was remarkably sober. He completely rejected the prevailing market exuberance.
What did he say?
He stated, and I quote, "The one guaranteed rule is that we will misestimate the amount of capacity that's required here, which by definition means there will be some overbuilding."
Wow. It's incredibly rare to hear a bank CEO openly predict a structural glut in the hottest sector of the economy.
Right.
They usually try to spin it as a generational investment opportunity.
Right. But Spence's pragmatism actually dictates their underwriting policy. They are intentionally capping their software and data center lending exposure at less than 1% of total loans.
That is disciplined.
And moreover, CFO Brian Preston emphasized that they're almost entirely avoiding the highly leveraged private credit space, again, keeping exposure below 1%.
It's like an insurance underwriter pricing a catastrophic hurricane risk.
Yeah.
You don't write a massive policy on the glass beach house sitting right on the shoreline, the server racks and GPUs that will be obsolete in 36 months.
No, you don't.
You write the policy on the concrete storm wall protecting the city. Fifth Third isn't financing the speculative compute power. They are financing the HVAC contractors, installing the industrial cooling systems, or the aggregate mining companies pouring the concrete foundations.
Exactly. They are banking the diversified hard asset businesses that benefit from the build-out, but aren't entirely reliant on its perpetual growth.
And that underwriting discipline is exactly why they were in a position to upgrade their forward guidance. They have built a fortress balance sheet, they have locked in their funding costs, and they are avoiding cyclical landmines. So let's look at how management is actually forecasting the remainder of 2026.
The guidance upgrades are essentially a clean sweep. They raised their full-year net interest income guidance to a range of $8.74 billion to $8.8 billion.
That directly reflects the sustained momentum from the fixed-rate asset repricing we discussed earlier, plus some highly tactical securities repositioning they executed the quarter to optimize their yield curve exposure.
They also raised and narrowed their full-year non-interest income guidance to $4.06 billion to $4.16 billion. That's driven by the structural compounding in the wealth management and new line payments divisions.
But the critical lever is on the expense side. While raising revenue, they simultaneously lowered their full-year adjusted non-interest expense guidance down to a range of $7.22 billion to $7.26 billion.
That is the definition of expanding the jaws of operational leverage.
Right. Upgrading revenue while downgrading expenses totally validates the speed and efficiency of the Comerica integration. And, when a bank generates that much excess capital, the focus immediately shifts to shareholder returns.
Oh, always. Fifth Third's CET1 capital ratio increased to 9.93%. Generating that level of core equity capital, even after absorbing the integration costs of a major acquisition, positions them incredibly aggressively against regulatory requirements.
Especially considering they have now officially transitioned to Category 3 regulatory status.
Which is a big deal.
It is. Crossing that $300 billion asset threshold triggers intense regulatory scrutiny, stricter liquidity coverage ratios, highly rigorous CCR stress testing requirements. But operating at a 9.93% CET1 ratio provides them massive buffer room above any baseline regulatory minimums.
And management isn't just modeling a rosy economic scenario for those stress tests either. They disclose that their baseline economic model assumes unemployment grinding up to 4.6% by 2027.
Right.
And they actively provision against a downside scenario where unemployment spikes to 8.5%. So they were generating this much excess capital while actively preparing for a severe recession.
Which brings us to the most actionable catalyst for the stock.
That's
Share repurchases. Management announced they are resuming their buyback program in the second half of 2026, targeting $200 million to $300 million per quarter.
The mechanics of a buyback at this specific valuation are just incredibly powerful. When the bank steps into the open market and retires $300 million of its own equity every single quarter, it forcefully condenses the share count.
So if you are a long-term holder listening to this, your proportional claim on the bank's future earnings mathematically increases without you deploying a single additional dollar.
Exactly. It also provides a structural floor against macro volatility. If the broader market sells off, the bank is positioned as a relentless, price-insensitive buyer of its own stock.
So, taking all of this data into account, the integration metrics, the deposit strategy, the credit discipline, and the upgraded guidance, it is time for the talk ticker's verdict. What is the fundamental reality of Fifth Third Bancorp right now?
Based purely on the mechanics of this transcript, our stance is unequivocally bullish. The market priced in significant integration risk when the Comerica deal was announced, assuming the standard frictional losses that plague large bank M&A.
Right.
Fifth Third has systematically dismantled that bear thesis.
They are executing flawlessly on a massive scale, retaining 99.4% of commercial clients while pulling forward $850 million in expense synergies, proves that their technological and operational architecture is vastly superior to historical industry standards.
Secondly, the organic growth engine is accelerating independently of the merger.
Yes, 16% annualized household growth rate in the Southwest.
Exactly. It proves that their direct marketing logic and digital platforms like Provide are highly scalable and fiercely competitive against national money center banks.
And finally, their absolute refusal to chase speculative yield. Capping AI infrastructure and private credit exposure at sub 1% levels while simultaneously over-reserving their ACL to 1.76%, that demonstrates a management team that prioritizes long-term tangible book value, compounding over short-term headline hype.
So for the retail investor, the actionable takeaway here is highly straightforward. If you hold FITV, this transcript validates your thesis.
Totally.
As CFO Brian Preston stated, the earnings power of the combined company isn't a forecast anymore. You are witnessing the realized cash-generating leverage of the combined entity today.
And if you are evaluating an entry point, the initiation of $200 million to $300 million in quarterly buybacks provides a massive structural floor. You are looking at a highly capitalized, geographically diversified regional powerhouse that is actively shrinking its share count while upgrading its revenue targets.
That's a very compelling setup.
It really is. Now, before we wrap up this deep dive, there is one final data point buried deep in the Q&A section of the transcript that we really need to discuss, because it has profound implications not just for Fifth Third, but for the fundamental structure of the banking industry over the next decade.
Oh, you're talking about the metric regarding their internal AI utilization.
Exactly. Management casually revealed that Fifth Third colleagues executed more than 1 million internal AI prompts in the month of June alone.
That is just wild.
And it gets crazier. They disclosed that 87% of all unit testing within their technology department is now entirely automated by AI tools. And a staggering 45% of all new code being written is AI generated and accepted into production.
The implications of that are staggering. We aren't talking about a Silicon Valley startup operating out of a garage. We are talking about a heavily regulated 160-year-old Midwestern commercial bank.
Right.
If an institution of this vintage is automating its software engineering, its IT migration logistics, and its daily employee workflows at this velocity, it fundamentally breaks the historical relationship between bank revenue and human headcount.
Exactly. Historically, if a bank wanted to double its assets or execute a massive merger, it had to aggressively scale its middle office headcount. More compliance officers, more risk analysts, more database engineers.
Yeah.
What Fifth Third is demonstrating is the ability to radically expand their operational footprint and throughput without a linear increase in human capital.
It suggests that the efficiency ratios we are analyzing today that drive down to 57.1% and the target of 53%,
Right.
that might just be the beginning of a structural paradigm shift.
Right.
If 45% of code is being written by an LLM, the future operating leverage of a tech-forward regional bank is going to look a lot more like a software company than a traditional depository institution. It is a silent revolution happening entirely within the operational guts of the bank.
It forces you to completely reevaluate what a bank's terminal margins can actually look like in the year 2026. All right, thank you for joining us on this Talk Tickers edition of The Deep Dive. Keep questioning the management narratives, strip away the corporate spin, and most importantly, stay ruthlessly focused on the data. We'll catch you on the next one.